Last quarter, a massive corporation you've probably never heard of pulled in nearly $500 million in pure profit.
Right. And the wild thing is, they don't manufacture vehicles.
No.
They don't sell software to everyday consumers. And they certainly aren't drilling for oil. They literally just made a list.
Yeah, but I mean, that list is arguably the most powerful document in modern finance, right?
Absolutely. It is a list that contractually dictates where trillions of dollars of the world's wealth must go, literally the moment the market opens.
Trillions.
Trillions. Today, we're looking at the invisible plumbing of the global financial system. We are tearing down the walls to see how the capital that funds the world actually flows from point A to point B.
Exactly. We were decoding the architecture behind the curtain, and our roadmap for this deep dive is a company called MSCI Inc. and their latest official financial results.
Right.
Specifically, we are diving deep into their SEC Form 10-Q filing for the first quarter of 2026, which ended on March 31st.
Yeah, and for anyone lucky enough to avoid reading corporate financial filings for a living, a 10-Q is the legally required quarterly performance report. Publicly traded companies have to submit this to the U.S. government.
And it's dry. I mean, it is completely devoid of marketing spin.
Oh, totally. There were no flashy graphics. No, visionary CEO quotes. It is just the unvarnished, densely packed accounting reality of how a business is actually performing.
Under the threat of perjury, they say.
Exactly. It's their financial diary presented under the threat of perjury.
Which makes it an absolute goldmine, if you know where to dig and what to look for. So our mission for this deep dive is to take that dense 10-Q and really extract the actual mechanisms of how this massive financial data and index provider makes its money.
Well, because it affects everyone.
Right. Because whether you are actively trading stocks every day or you just have a basic, set it and forget it retirement account, you really need to understand these invisible scorekeepers of the economy. They have a direct impact on your financial future.
They really do.
Okay, let's unpack this.
So to understand the sheer scale of the power we're talking about, we really have to start with the top line of this filing. For the first 3 months of 2026, MSCI brought in $850.8 million.
Wow.
Yeah, $850 million in total operating revenues. That is a 14.1% increase compared to the exact same quarter last year.
14%. I mean, in the mature, highly consolidated world of financial services, maintaining a 14% growth rate at that kind of revenue scale it's incredibly difficult.
It's almost unheard of.
Right. And when you break down that $850 million, you realize they are not relying on a perfectly balanced portfolio of products.
No, not at all.
They have different business segments, right? Analytics, sustainability and climate, private assets.
But there's one absolute heavyweight dominating the room. Out of that $850.8 million total, their index segment alone brought in $496.3 million.
That is well over half of their entire business.
Yeah. That index segment it's the beating heart of the company. It's the division responsible for categorizing, grouping, and really measuring the performance of different segments of the global stock market.
And this is where I think a concrete analogy helps us kind of visualize what they're actually selling, because it can get abstract.
Sure.
Think of MSCI as the ultimate DJ of the financial world. They don't write the songs, They don't build the individual companies like Apple or Microsoft or NVIDIA.
Right.
But they curate the playlists. They build these massive indexes that group certain stocks together based on geography or market size or specific industries. And everyone in the financial world wants to dance to their playlists.
I love that analogy. And what's fascinating here is let's look at the mechanics of that relationship, because it reveals just a staggering concentration of power in modern finance.
Yeah.
When MSCI adds a song to their playlist, the nightclubs don't just listen. They're forced to act.
They have to buy it.
Exactly. The 10-Q filing points out that BlackRock, which is the world's largest asset manager, accounted for 11.7% of MSCI's total consolidated revenue.
Which is huge on its own.
It is.
Yeah.
But if you zoom in on just that massive index segment we talked about, BlackRock accounts for an astounding 19.7% of it.
Wait, a fifth. A fifth of their main business comes from a single client.
A single client, yes.
So if MSCI is the DJ, BlackRock is literally the biggest nightclub on earth, just paying massive fees just for the privilege of using the playlist.
Exactly. And BlackRock relies on that playlist because of how they structure their own products. BlackRock builds ETFs, exchange-traded funds, and many of these funds are explicitly legally designed to track MSCI's indexes.
Right, they have to mirror it. Exactly.
Right. The mechanism here is crucial. When MSCI decides to add a new company to an index, BlackRock's algorithms don't have a board meeting to discuss it.
They just do it.
They automatically execute buy orders for millions of shares of that newly added company the very next morning. So MSCI doesn't just suggest where the capital should go. Their intellectual property directly drives the physical flow of global wealth.
It's just a fascinating dynamic because BlackRock does the heavy lifting, right? Actually buying and holding the stocks, dealing with the brokers, managing the trading infrastructure.
Yeah, the messy stuff.
Exactly. And MSCI just sells the blueprint. But that brings up the obvious question. How exactly does MSCI charge for these blueprints? Because they aren't just selling a subscription for a flat monthly rate, are they?
No, not just a flat rate.
They are basically taking a cut of the crowd size at the nightclub.
Yeah, that's exactly it. Now, they do have a base layer of recurring subscriptions. That brought in around $600 million. But the real high-octane growth engine, the mechanism you're referring to, is what the filing calls asset-based fees.
Asset-based fees, okay.
These fees jumped 26.6% year over year to $224.5 million for the quarter.
So asset-based fees operate exactly the way they sound, right?
Pretty much.
The more money everyday investors pour into an ETF that happens to use an MSCI index, the more money MSCI makes. They take a tiny slice of the total assets under management.
Right, and that slice is measured in what the industry calls basis points.
Yeah.
For anyone unfamiliar with the terminology, 1 basis point is equal to 1/100th of a single percent.
Which sounds completely microscopic.
It does. It sounds like nothing. But you have to apply that microscopic percentage to the sheer volume of money sitting in these funds. The 10Q reveals that the total assets under management, the AUM and ETFs linked to MSCI equity indexes, is currently $2.403 trillion.
Trillion with a T.
Trillion with a T.
That is mind-boggling.
When you are charging basis points on $2.4 trillion, those fractions of a penny compound into hundreds of millions of dollars in pure revenue.
But wait, I want to push back on this model for a second because the filing exposes a potential massive vulnerability here.
Okay, let's hear it.
It explicitly notes that their average basis point fee, like the actual percentage rate they are permitted to charge these asset managers, decreased.
Yes, it did.
So wait, if BlackRock is squeezing them and their fee percentage is shrinking, aren't they incredibly vulnerable? If the stock market suddenly takes a dive tomorrow, the total AUM shrinks. If the AUM shrinks while their fee rate is simultaneously dropping, doesn't this entire revenue engine completely fall apart?
You are pointing out the exact systemic risk that analysts worry about with asset-based fees. It's a real concern.
Okay, so it is a flaw.
Well, the dynamic you're describing is called margin compression. As massive clients like BlackRock bring more and more money to the table, they possess the leverage to negotiate steeper volume discounts.
Right. They say, we bring you trillions, give us a break.
Exactly. So yes, MSCI is making slightly less per dollar than they used to. However, the filing shows exactly how they insulate themselves against this. The sheer overwhelming volume of new money pouring into the system outruns the margin compression.
So it's essentially a volume game. A slightly smaller slice of a rapidly expanding pie still results in more total pie on your plate.
The math completely supports that. Look at the capital flows just for Q1 2026. In just those 3 months, there were $103 billion in brand new cash inflows into ETFs linked to MSCI indexes.
$103 billion in 1 quarter.
Yes. That is $103 billion of new money that everyday investors deposited from their paychecks or retirement accounts. And on top of that new cash, the overall stock market appreciated in value during the quarter.
So the assets just grew naturally, too.
Right. When the overall pool of money expands by hundreds of billions of dollars, it completely masks the fact that the specific unit price they're charging has dropped slightly. They are surfing a trillion-dollar wave of passive investing.
Okay, so the revenue engine is clearly firing on all cylinders. But if margin compression is a constant looming threat from behemoth clients, MSCI can't just coast on public stock indexes forever, right?
No, they can't.
They have to spend money to find new frontiers. And looking at their expenses in this 10Q, they are aggressively allocating capital. Their operating expenses rose 6.8% to $393.9 million.
And the allocation of that $390-odd million is really the most telling part of this filing. It shows us exactly where MSCI believes the future of finance is heading.
Yeah?
They spent $71.4 million in the first quarter on 2 strategic acquisitions. Compass Financial Technologies, and Vantager. Compass builds indexes for multi-asset and alternative classes, which broadens their traditional offerings. But Vantager is the critical pivot.
Here's where it gets really interesting. Vantager is an AI-enabled platform designed specifically for private market due diligence and data extraction.
Right.
So buying Vantager is basically like buying a high-tech, AI-powered metal detector for the private markets. Because private companies don't have public stock tickers, the reliable data is buried deep underground.
Exactly. And the mechanics of how Vantager operates highlight why private markets are the next great frontier for data companies. In the public markets, data is commoditized.
Anyone can look up Apple's earnings.
Exactly. Everyone has instantaneous access to Apple or Microsoft's financial data.
Huh.
But the private market, which consists of private equity, private credit, venture capital, it operates in a complete blackout.
Yeah.
Those private companies do not file standardized quarterly reports with the SEC. Their financial health is locked away in messy PDF pitch decks, disparate spreadsheets, and dense, unstructured legal documents.
So no one can easily build an index for the private market because you can't even get all the companies onto the same spreadsheet to compare them in the first place.
Until now. That is the hurdle Vantager's AI is built to clear. It uses large language models and machine learning to literally crawl through that unstructured chaos. It reads the messy PDFs, extracts the relevant financial data, and standardizes it into a clean, usable format. By acquiring this technology, MSCI is acquiring the capability to map the unmapped territory. They want to be the entity that finally builds reliable, universally accepted playlists for the opaque world of private capital.
So they are aggressively pivoting into AI and private markets.
Right.
But making those acquisitions and building out those capabilities requires massive human capital.
Oh, yeah.
And the 10Q outlines a very specific operational strategy regarding their workforce. They report having 6,319 employees globally. But they explicitly state that 71% of those employees are located in emerging market centers.
Yeah. This is a textbook execution of labor arbitrage.
Right.
They are intentionally managing their largest expense category, which is compensation, by strategically placing the vast majority of their headcount in regions like India, the Philippines, or Eastern Europe.
And the cost savings are just laid out right there in the math. The filing shows they managed to grow their total headcount by 2.2% this quarter, bringing on more data scientists and engineers.
But look at the cost.
Right, yet when you adjust for acquisitions and currency fluctuations, their overall compensation and benefits costs only rose by 1.8%.
Amazing.
They are literally growing their workforce faster than their payroll.
It is the defining operational engine behind their profitability. Think about it. They use AI to automate the heavy lifting of data extraction, and they offshore the remaining human labor to emerging markets to keep compensation strictly controlled.
Wow.
You combine that tightly managed expense structure with the skyrocketing revenue from a trillion-dollar wave of ETF inflows.
Yes.
And the logical outcome is a massive surge on the bottom line.
The numbers validate the strategy completely. Their net income jumped 40.7% year over year to $406 million, and their diluted earnings per share reached $5.53.
And just to ensure we are crystal clear on the accounting terminology here.
Yep, please.
Diluted earnings per share, or diluted EPS, is actually the most conservative way a company can measure its profit. It takes the total net income and divides it by the total number of shares. But it assumes that every single outstanding stock option, warrant, or convertible bond is suddenly cashed in for shares today.
Oh, so it pretends the share pool is as big as it could possibly be?
Exactly. It dilutes the profit across the maximum possible number of shares. So generating $5.53 per share under those worst-case scenario assumptions in a single 3-month period. It's a testament to the cash-generating power of this business.
But looking at that bottom line is where the 10Q threw a massive curveball that I did not understand at first glance.
The taxes.
Yes. If you're listening to this and remembering the absolute headache of paying your own income taxes this past April, hearing about MSCI's tax situation for this quarter is going to make your blood boil.
It usually does.
The filing states their effective tax rate for Q1 2026 was negative 4.3%. Hold on. They reported making $389.2 million in income before taxes, but their tax rate was negative. Did the U.S. government actually send them a refund check for making almost $400 million? How does a company pull that off?
Well, no government agency wrote them a physical check to pad their bank account. The negative 4.3% rate is the result of a very specific, perfectly legal accounting mechanism known as a discrete tax benefit.
Okay.
The filing explains that they recognized an $88 million benefit because they completed a, quote, multi-phased internal legal entity restructuring.
Okay, we need to translate multi-phased internal legal entity restructuring into actual English.
Fair enough.
How does restructuring erase your tax bill?
The easiest way to conceptualize a multinational corporation like MSCI is to picture a massive corporate attic, and it's filled with hundreds of different boxes.
Okay, I'm picturing it.
Each box represents a different subsidiary company operating in a different country, governed by different tax laws. Over decades of acquiring other businesses and expanding globally, that attic becomes incredibly disorganized. Some of those subsidiary boxes are generating massive profits and owe heavy taxes. Other boxes contain historical losses or unused tax credits from years ago that just haven't been utilized.
So they basically went up into the corporate attic and reorganized all the boxes.
Essentially, yes. They engaged their legal and accounting teams to completely redraw the floor plan of who owns what internally. By legally shifting the ownership structures and consolidating certain subsidiaries, they were able to surface those historical tax credits.
And apply them to today.
Exactly. They legally applied them against the massive income they generated this quarter. They unlocked $88 million in legally viable tax shields.
Wow.
Because this $88 million benefit was recognized all at once during this specific 3-month window, it mathematically pulled their effective tax rate for the quarter down below zero to negative 4.3%.
So it's a paper phenomenon, but the result is very real cash flow.
Oh, absolutely real cash.
It turns a great operational quarter into a spectacular quarter on the final balance sheet. Which brings us to the final piece of the puzzle here. They have this massive influx of cash from operations, plus they've shielded $88 million from taxes.
Right.
What do they actually do with all that liquidity? They clearly aren't just letting it sit in a low-yield checking account.
Definitely not. They flushed a massive portion of it right back out to their owners. The filing details extensive shareholder rewards. They spent $399.3 million on share repurchases.
Let's break down the mechanics of a share repurchase for a second, because that means MSCI literally went out into the open stock market and used their cash to buy 0.7 million shares of their own company, essentially ripping those shares up and taking them out of circulation forever.
Precisely the mechanism.
Sure.
And by artificially reducing the total supply of shares available in the market, every single share that remains in the hands of their investors suddenly represents a slightly larger percentage of ownership in the company.
It makes the remaining stock inherently more valuable.
Exactly. It's supply and demand.
And on top of spending nearly $400 million to shrink the share count, they also declared a $2.05 per share dividend.
Which is a direct cash transfer. They distributed roughly $148.9 million in hard currency straight into the brokerage accounts of their shareholders.
Incredible.
When you combine the aggressive buybacks with the dividend payouts, MSCI returned well over $500 million to their owners in a single 90-day period.
$500 million?
Yeah, it is the ultimate hallmark of a highly scalable, asset-light business model. Once the index algorithm is written or the AI data platform is developed, selling access to one more client costs the company practically nothing. The profit margins are exceptional.
So what does this all mean for the person listening to this right now? We've talked about DJs controlling the nightclubs, AI metal detectors digging through private markets, and corporate addicts hiding millions in tax shields.
Sure.
You might be sitting there thinking, you know, I don't own a single share of MSCI stock, and I don't run a hedge fund. Why do I care about this 10Q?
You should care, because this architecture directly interacts with your personal wealth.
Yes.
If you have a 401k through your employer, if you have a pension, or if you own literally any broad market ETFs in a personal brokerage account, your money is flowing through the specific pipes that companies like MSCI design.
That is the ultimate takeaway here. Every time part of your paycheck is automatically deposited into a passive index fund, a tiny fraction of a cent is mathematically carved out and routed to MSCI's bottom line, just for providing the structural blueprint of that fund.
Exactly. They are the invisible hand guiding trillions of dollars of global capital. And that reality leaves us with a critical, much larger question to ponder. As we saw in this quarter's numbers, index providers are taking a larger and larger slice of the global asset pie. They dictate the flow of public capital. And now they're deploying artificial intelligence to map out and structure the historically opaque world of private markets. If this trend continues unchecked, at what point do the scorekeepers of the economy start holding more influence and power than the actual players on the field?
It certainly makes you wonder who is really writing the rules of the game. That invisible plumbing of the global financial system, it turns out it's not so invisible once you know how to read the blueprints.